everyone has to understand we're making investments here, right? And so the higher projected return, everything else being equal, the higher the risk. And risk and return in and of themselves are not necessarily the deciding factors in whether or not you should move forward with investment. You have to, one, I think, look internally where you are in your own life, what your investment portfolio looks like, and how much risk you're ultimately willing to take on, right? But when we look at things like more on a risk-adjusted basis, we're looking for projects that we believe are achieving or projected to achieve higher returns than the risk would otherwise justify. And so in real estate, we talk about we want value add returns with core or core plus risk profiles. And what that really means is we want a mid to high teens return, but we want a risk profile of a deal that is a low 10, 11, 12% IRR profile. And so at the end of the day, we're looking for projects that we believe have additional upside. Now, the question is, how does that upside get created? If, we obviously are not living in an efficient market, but, we like to believe at some level that, projects are balanced over the course of time, and that, the riskier projects will have projected higher returns and vice versa. But as, we figure it out, it's, doing things like being able to buy a deal off market. When you're in an interest rate environment like we are now, where the cost of borrowing is so low, you have a lot of groups out there that are willing to pay substantially more than what we would call a kind of market price, just because their cost of borrowing is very low. And so when you have a deal that's widely marketed and you have 20 different investment groups that are bidding on that property, I'd be hard pressed to find a deal like that where you're buying it at what I would call a fair or better than fair market value. And so we try to work with groups that have stronger local market knowledge, meaning they know the local brokers, they get first looks at deals, they know folks in their local markets who may be willing to sell or looking to sell, and they're trying to get in there before this deal even gets close to being marketed. And that's a big way of how you create value out of the gate. Another key way is just having the right sponsor partner who's managing a deal. Now, there are some groups that have billion-dollar portfolios, and what comes with that are the economies of scale of having full teams of people, regional managers, district managers who understand the dynamics of the marketplace and can immediately go into a property that, was previously either run by a non-institutional owner or a mom and pop, and they can add immediate value just in the form of operational efficiency. It's another way that you create additional value without taking on more risk. So there are a number of factors that you could look through. We write about this stuff often in terms of trying to find deals that present very well on a risk-adjusted basis. Again, there's no bright line rule or follow these 5 steps to find the best risk-adjusted deal, but there are a lot of factors you can evaluate. Those are a few.